Hello, everybody, and welcome to Wall Street Hackers, one of the top-rated shows on the IBM TV Pod TV network. I'm Nick Pallavi. I'm going to be your moderator today, and this is where we discuss some exciting opportunities that exist in investing. And with that, we're going to bring in the hacker himself. He received his bachelor's degree in economics at UCLA. He also received a law degree from the University of Miami and his MBA with an emphasis in finance from NYU, spending 17 years in New York City working in finance. We're going to bring in the hacker himself, Peter Bennett. Peter, it's another new week and another interesting stories I'm sure that you're going to have relating to investments. So,
oh yeah, always the markets are always interesting, and welcome everybody. So we start with the cover of Barron's magazine this Sunday, this edition, and it says, quote, what everyone got wrong and the ominous implications for the Fed. Again, what everyone got wrong, that's what they're saying. But a few points. One, not everyone did get it wrong. There were people who were saying inflation was coming and the Fed and the markets ignored it. And the other thing is that this will relate heavily to the panel discussion of the week. Basically, we're going to be looking at who to blame for how bad the forecasts have been for the last year and a quarter, not just to look at the past, but also to look at the present and the future. So we'll be getting into that after the advertisement in the middle of the show. So the Fed is still in their middle of their very untested experiment. They're trying to raise slower and keep it, and saying they're going to keep it high longer. But this has no real evidence that it's ever been proven. And let's see how they're doing. So first, we have two charts, which I just have to bring up one more time. We showed it last week. If we could bring up the core CPI chart. And so you can notice that this is one of the indicators that the Fed looks to the most as an indicator of inflation and how they're doing. This does not look like they're making any progress. Looking since 1920, it rose and it's basically been stagnating. So where's the progress? Then let's look up at the core services chart that we showed last week. If we could bring that up. If we can, oh, there we go. Okay, great. So that's the same one. It's okay, unless I switched. I'm sorry about any mix-up, but basically they say the exact same thing. So the core services chart looks like this, and basically, again, since 1920 it rose, and now it's just floating around the same rate. And so let's look at this week, and the personal consumption expenditure price index jumped 0.6% from December. It wasn't expected, and it's in that same realm of 7% inflation. And the core PCI, which is always lower than inflation itself, was up 4.7%. And again, no indication of slowing. So where's the evidence that after a year and a quarter that this untested experiment is working? In other words, related news, and it does relate to this experiment too, the housing has been one of the first areas where you started seeing some signs of the market adjusting to inflation. And mortgage rates are so high. But the housing index for Case-Shiller was up 5.8% in December after a 7.6% in November. Again, in that same realm of 7%. And new housing, this is really bad news. New housing starts jumped to a 10-month high in January. Now, out of the 5 elements that Wall Street Hackers has been talking about for a year and a half, saying that the Fed has not got this under control, housing was going to be the first one to turn. But now new housing starts are jumping. So where's the progress? There is none, basically. So now the street are and the markets are upping their expectations for the higher terminal rate. So Goldman Sachs and Bank of America said that they now predict 3 rate increases in 23. But this has been going on for a year and a quarter. Maybe somebody should notice the pattern. The market keeps adjusting the rates up. The Fed keeps adjusting their projections up, but they've been so far behind the curve. And the markets, some in the markets are now predicting a 6.5% terminal rate, and I wouldn't be surprised at that at all. I want to read something from the Financial Times that I did read last week, but it's so important. It said, since the 1950s, the U.S. economy has tipped into a recession within 2 years every time inflation has exceeded 4% and unemployment has fallen below 5%. So we're so far above inflation. We're so far too low on unemployment. In other words, unemployment is around 3.4, a 50-year low. And so what makes the Fed think that all of a sudden the pattern since the 1950s is going to be broken by their untested experiment? Quotes of the week. And a lot of these obviously are ones I picked out because they go with the paradigm that I'm saying is the truth, which is the Fed is behind the curve and inflation is going to be a long battle. So the chief economist of Wells Fargo, but these are smart people too, it's not just me. Chief economist of Wells Fargo, the Fed is, quote, flying blind. In other words, it's an untested experiment. The senior economist at the Center of Economic and Policy Research, quote, we all have ideas, but we have to recognize we're really kind of shooting in the dark. Again, untested experiment with no evidence. Barron's Magazine. This one I really like to tear into. It said, it's impossible to apply the old rules to a new economy, one that has been completely and permanently transformed by the COVID pandemic and no longer responds in the same way to tighter monetary policy. Hang on a second. One, why is it impossible to apply the old rules? The old rules have worked for 70 years, and the history is basically they work 100%. The new rules are an experiment that has never been tested. And just because we had COVID, it doesn't mean that any of these rules that have been tested in so many ways for 70 years are fake or all of a sudden to be thrown out. The markets haven't, and they said that the markets haven't responded. Yes, the markets haven't responded because the Fed is moving slower and more deliberately than in terms of rates and levels and the speed of changes compared to what history says they should be doing. So again, we're going to get into who to blame for this as an instruction for the future, but I don't believe it. You know, the studies show that based on 70 years history, the Fed is not doing the right thing. They can't do this slower. And if we do go into a recession, the bottom line is the average recession results in a market downturn of about 35%. The market was down about half of that. Now it's come back a quarter, roughly. So there's a long way to go. Most interesting stories segment. The U.S. energy, and this is one that was all over the news. So a lot of people have heard it. Now, if you only listen to certain media, maybe you didn't even hear it, but this is one that's been out there. The U.S. Energy Department changed their stance on COVID, and the FBI is now agreeing, saying that likely it was the Wuhan lab that created it. Now, many people believe that, and some of the media was saying it 2 years ago, 3 years ago. But then you look at, I try not to get into politics, but it's the liberal media, and I'm going to explain why they're hurting both sides in a minute. But the liberal media for years said, this is a conspiracy theory. They refuse to put it on broadcast. Tech, same thing. You can't even say this is possible. It's a conspiracy theory. Well, we need an ethical reporting system, and a free press is so important, and not one that's beholden to one party or another. Now, you'd say, okay, well, this seems very, pro-conservative and anti-liberal. First of all, I'm not that. It depends on the issue. But my point is, I believe that the liberal press is actually doing almost as much damage and in the long run, maybe more damage to the liberal and the Democratic Party versus the Republican Party. Now, how could that be? Well, one, when they say these lies, another one, by the way, was the Biden laptop is a conspiracy. You're not allowed to say it at all. You're not allowed to report it. For years, they said this. There's so many other examples. But so when they do this, who are they really hurting? Well, in the short run, they're definitely convincing people that, these stories aren't important. But in the long run, they're diluting the Democratic Party and the liberals in two ways. One, they're not having to come up with the real arguments that they have. There are certain issues where the blue side has strong arguments, but they don't need to develop them if they're covered up. The whole debate is covered up with a lie. And second of all, and this is even more complicated, but I think the quality of the candidates may be hurt by that, because a poor candidate who can't really argue the blue side well might not get eliminated because they can hide behind stories that never come out or the conspiracy theories. And so it would be a lot better for both sides and America, for sure, if the press would start reporting on both sides, and tech especially too, allowing both sides and a free press. I mean, that is the bulwark of a society. In non-political news, more at least. So the books of Roald Dahl, including the story about the Oompa Loompas, Charlie and the Chocolate Factory, has now been rewritten. So the Oompa Loompas are now going to be gender neutral. Now, I wonder, among other things, are they going to redo the movies? Because those Oompa Loompas definitely look male to me. So I think they'll have to redo the movies. Number two, Russian GDP contracted by only 2.3% in 22. People think, oh, these restrictions are working so well, and they are affecting the Russian economy. But what's happening is a number of things. Number one, India and China are buying up Russian crude and reselling a lot of it to the West, and especially to Europe. Number two, Turkey especially, and other countries are buying up Russian fertilizer, and they're reselling some of it. Same thing goes for coal, steel, iron, and gold. So in a world economy where a lot of countries aren't cooperating, they're undermining the effort to undermine Russia, which is really surprising to me, but it's interesting. And a perfect example of this is Russian sales of coal to India are up now 147% in 2022. So we'll see if these sanctions work, but they'd be a lot stronger if we had a true global cooperation. A mobile home in the Hamptons is now under contract for $3.7 million. It's 800 square feet. It does have 2 bedrooms and a nice ocean view. I'm not sure it's worth 3.8 million, but that's the market. Interestingly, in Venice, Italy, tourists are now going to have to forego gondola rides because the water levels in Venice are so low this year, which is really surprising, obviously, given the fact that people think Venice is sinking, maybe the oceans are rising. But the water levels in Venice are so low this year that they can't even support the gondola business. And we'll see how it goes in the future. Finally, and back to financial news, Intel, surprising to many, cut their dividends substantially, not totally, but substantially. I think it was about 60%. And this just shows you why, if we're heading for recession, well, I do believe we're heading for recession sooner or later. They can delay it, but it's going to be very hard in the market on companies. They're going to, especially though, companies with poor cash flows, or modest cash flows, and in cyclical industries. So we're going to take a break, and then we'll get into the dividend stock of the week and our panel discussion.
Welcome. Today, we're going to look at a unique tax planning opportunity using a little known plan to create huge tax deductions for 2020. So listen up to this not well known plan called 412E3. And today I have a special guest, Max Culiet, who's a certified financial planner, a registered investment advisor, to help us with understanding 412E3 plans. Max, what is a 412E3 plan?
Well, Nick, simply put, a 412E3 plan is a pension plan that must be funded with qualifying insurance contracts, certain life insurance and annuity contracts. The contributions to the plan are fully tax deductible for federal income tax, state income tax, and typically they save some on Social Security and Obamacare taxes as well.
Max, I have a client right now who's facing a $100,000 tax bill for 2020. Can you do anything for him today in 2021 for a 2020 tax bill?
Yes, we can. You know, the Secure Act allows us this year to set up a plan in 2021 prior to filing income tax returns to benefit the client for 2020 and their tax problems. In many cases, we can, by doing that, deduct $100,000, $200,000, and in some cases, $300,000 or more in this kind of a pension.
$100,000 or more tax deduction in a pension? I thought you were limited to $19,500 in 2020. How did you get to $100,000?
Nick, you're right. $19,500 is a 401k limitation. Every plan has its limits, like a profit sharing plan has a limit of $57,000. Then there are some catch-ups, of course, but a pension plan is different. It's actuarially determined and could easily, based on the amount needed to fund that pension, be over $300,000.
Max, does your firm work with TPA? As a TPA firm, do you work with CPA firms in helping set up these plans? Are CPA firms people that you normally work with?
We work with CPA firms almost 100% of the time on each plan we do. Setting up and administering these plans, we're there to help as the TPA to make sure the plans are designed and set up in such a way that they're in compliance. And we also help the CPAs help their clients qualify for a tax credit this year because of setting up a plan. And as a third-party administrator, we're responsible for filing the 5500 forms, making sure the plan is in compliance with the IRS, the PBGC, and the Department of Labor. And we also employ CPAs. We have CPAs and we have enrolled actuaries, tax attorneys, et cetera, that work for us to review these plans, make sure we're staying in compliance and doing the things that will benefit the client most.
Well, Max, I want to learn more about these plans. How can I find out about these plans and if these plans work for my clients?
Well, Nick, it's pretty easy. Give us a call. Call me at 877-252-1692, and we'll get back to you. We'll, sit down and have a meeting, or you can even email me at max@nationalpensions.com. Either way, we can then set up a time to review your specific, client and their circumstances, and probably design something that could be very beneficial to them in the future.
And we're back. So, hi, Kim. So what to do, same thing I've been saying for a year and a quarter. And it looks to me like it's almost certain, nobody can say for certain, but it looks to me like we're sooner or later going to have a recession. Inflation's out of control, as it has been for over a year. And you have to be very defensive, own very defensive Stocks, dividend stocks always generally perform better than regular stocks. Own energy, because we're probably heading for a gigantic energy crisis. It's really something, the way there's been underinvestment for years and years. It's going to come home to roost, almost certainly. And who knows where it'll go, but that'll hurt the economy too down the road. So you have to be very, very defensive in this market. You know, the Fed is doing an untested experiment. We're going to discuss that very shortly. But there's no evidence that it ever worked before or that it's going to work. So maybe it will work, but I doubt it. So dividend stock of the week. First, a few notes. One, I hate to ever sell a stock. You know, Warren Buffett, I'm not Warren Buffett, but I love to buy a stock and just hold it for the dividend, let it grow. But Ryder, I recommended only about 14 or 15 weeks ago. It's up 32%. And when a stock goes up that much, I start having to look at it again. Plus, I read some articles about that it could be cyclical. I'm not sure it is. But now the dividend's 2.5%. I was a very small allocation, less than 0.25%. But then again, most of my allocations to stocks are. But I said, you know what? At this point, I don't need the risk. And 2.5%, I get 4% in a treasury bond, or a lot in just money market these days. So that's the problem. You know, the substitutes get stronger and stronger as the rates go up. Also, UAN, I just want to mention that CVR Partners. Again, under 0.25%, but I'm kicking myself. In a way, it hasn't risen, but I'm always questioning whether I should buy more. But it's a fertilizer company. The Ukraine crisis has affected it to a point, positively. But last quarter, I said that their production plants were down, but it just came out with a dividend of $10.50 for the quarter on a $110 stock price. So that wasn't bad for the yuan, and the market didn't even go up on that. I've noticed that the market doesn't respect dividends at all. The small investors do, and some investors do in the market, but overall, you can announce great dividends, whatever. It doesn't really affect things. I guess some people would rather not get the dividend and have it reinvested, but the stock might have jumped a little. Anyway, dividend stock of this week is EIFZF, Exchange Income Corporation. It's a Canadian company. Only, again, less than 0.25%, but I might buy more of a lot of these less than 0.25% down the road. But I don't like the macro picture because I think we're heading for a recession and the market could get slammed. Rates are probably going to go up more. So, but it's defensive because it's two businesses it provides cargo to northern Canada. Now, these are not places where there's a lot of competition to deliver freight to northern Canada, the Indian tribes and the northern territories. It also does auto parts. It is a 4.96% dividend yield. Its price to cash flow is 6.5, according to GD Ameritrade, which is a 15% cash flow yield. So it's got very healthy cash flows. And if you look at the last 5 years, its annual growth rate in earned EPS was 3%. Not great, but steady. Its revenue has been growing 15% annually on average for the last 5 years, and its dividend, not great, but not bad at 2.8%. But again, at 4.9 to pretty much 5% with a 2.8% dividend increase, if it keeps that up over a decade or two, it could be better than a bond substitute. And, so I'll play with that, a little bit. So now our panel discussion of the week. The question is, who to blame for the totally misguided forecasts about the market that have been coming out for well over the year, the Fed or the markets? Now, it's not just about blame, but it's, who do you trust today? I don't probably trust either one, but anyway, so who do you blame, Nick and Kim? The Fed, the markets are equal, or what do you think?
Well, I think there's a lot of blame to go around in terms of where the market is. So you can't allocate it all to one sector. You can't allocate it all to the government, but they have some responsibility since they're about 25% of our entire U.S. GDP. Oh. So they have responsibility. The Fed, obviously, because they control the interest rates, have responsibilities. And of course, the media reporting on this has a certain amount of responsibility. So you really have to allocate the responsibility around in terms of where it's going. In terms of recession, even though you say, well, they say we're not in a recession, I can tell you there are certain sectors that are in a recession today. And the reason why is I get reports from my pension clients. And the sector that's in a recession today is real estate. Absolutely no question. The market has dried up. It has cost people jobs right now. They're just not really reporting very heavily on how bad it is out there. But the real estate market, Peter, is right now in a recession. The energy market, as you well know, all the people out there listen to paid more in gas. Well, Chevron and Shell had record profits. So the money kind of slipped over to the oil and gas industry. So yes, you paid more, but if you didn't invest in the oil and gas industry, you didn't reap the profits on the other side of the market.
A few points about what we said. First of all, that's a good point. It is true that the Fed controls the interest rate. That wasn't even my main point of where what I was thinking, but it's true. They're the ones who haven't raised it fast enough. So in a way, that does point to the Fed. In terms of the real estate market, first you have to break down personal real estate market versus commercial. In the personal real estate market, you read articles all the time about sales going down, but prices are not going down. As a matter of fact, they're still up a lot year over year. Maybe they're starting to turn, but what we have is a frozen market. That's the best description in the personal market. So the sellers are saying, I'm not dropping my prices a lot, and there is a shortage of housing for demand. But the buyers are saying, well, I'm not in a rush to buy now. So demand keeps going down, and sooner or later, I think the pressure will come on the selling side. And I've been predicting that for a while. So I think eventually prices will come down. But the fact that they haven't come down and the fact that new housing starts just increased to a 10-month high just indicates, again, how far behind the curve the Fed is in terms of raising interest rates. And how about you, Kim? What about the Fed versus the markets, whose fault it is on messaging and everything else?
You know what I'm going to break out?
Oh, the crystal ball.
Peter, I used to think we could predict these things. And I think what happens is experience, right? And this is something that I have learned maybe in the past 20 years is the experience has taught me, certain trends happen and then certain things happen. But even sometimes, no matter how well you've planned or you've learned or you think, but, you just don't know, right? So I'm going to pray this time. I can't say who is responsible. I have to agree with Nick. I think the media has played a lot in the way people are doing things, because I hear a lot of people saying that they've listened to and heard that, and they're getting all of this from media. They're not on Wall Street listening to these things, right? So I think the media is probably more to blame than any.
Oh, I didn't even think about that one. You're right, though, the media. But you know what? Again, the media is only taking their cue from the people in the market, the forecasters, and the Fed itself, which are giving them the messages. So, in politics, I think the media is so dirty, and so unreliable. But when it comes to finance, I think they're just parroting what is told to them. But so a few points. One, I originally went and said it's 50-50. The markets are just as much to blame as the Fed. But first of all, I came up with an argument. But even before that, I'm going to say Nick has a good point. The Fed is the one who's been moving the interest rates up too slowly, because they're doing, again, this untested experiment. And by the way, I understand why they're trying to do it. They're trying to avoid a recession. And they also, the other thing is they have to sound confident, because if they said, well, we're doing an untested experiment, there's no data for 70 years that it's ever going to work, but we think it might work this time, it wouldn't be very confidence inspiring for the market. So I don't blame them for sending a positive message. And maybe I don't blame them for this experiment, but if it doesn't work, it's mostly on them. But my original point was where I moved off of 50-50 and moved towards the Fed again is I started thinking about crypto and Sam Bankman-Fried. So some people, I think personally, Sam Bankman-Fried knew a lot a lot anyway, and he isn't as naive as he claimed. But let's say that he's a Bernie Madoff who's totally naive. He's like just not too bright. So if he put up this scam and he wasn't too bright and he was totally naive, I would still assign about 80% or more of the blame to him, even if he fooled the market. So if the market said, we love Sam Bankman-Fried, but because he's great, but then it was all based on, his misleading statements, even if they are naive, I'd have to say that. So, you know what? I blame the Fed for a lot of this, but both the markets and the Fed have been for a year and a quarter totally off the mark, or mostly off the mark. I think actually totally off the market, because I think the market should be a lot lower. It came back a bit, but at least in my prediction, and as Yogi Berra said, it's the hardest thing to predict is the future, or something along those lines. I don't know. I'm not going to say I know. Some people say they know. Nobody can know for 100%, but all the evidence based on so many years tells me we're heading for a longer slog because the Fed keeps growing slowly. And until they catch up and really say, okay, we need a recession, which is what we always needed to slow inflation, we're probably going to be fighting a losing battle, and you have to be defensive in the market. So we're running out of time. We have a very interesting, the energy show. It's very different because we're going to be talking about universal energy. So it's kind of a strange discussion, but I think it'll be interesting for a lot of people. So if you're interested, the energy show comes in next. If not, tune in next Thursday, starting at one on every week, and we'll see you then. And as Kim always says, I say the first part, get healthy.
Get wealthy.
There you go. Coordination in a different form. We'll see you next
We did
week.
it.
Thanks.